Good evening from India. My name is Akshay Mathur. I'm the Director of Observer Research Foundation, Mumbai, and the head of ORF Geoeconomics program. I welcome you to this edition of the T20 Spring Roundtables 2021. As most of you know, the T20 is the official sub-forum of the G20 for think tanks. The think tanks which participate in this forum are typically that have expertise in global economic governance, globalization, and of course the G20. This forum serves as a policy research and advice network to the G20 officials. Under the G20 presidency of Italy in 2021, the T20 Italy Secretariat is hosting a series of meetings, the T20 Spring Roundtables, with select think tanks globally, which have been leading or contributing to task forces in 2021. ORF is co-chairing 2 such task forces this year, along with our Italian colleagues. And in line with our leadership in past G20 presidencies, Saudi Arabia 2020, Japan 2019, Argentina 2018, and right up to Australia in 2014. This panel today is being co-hosted by ORF with the chair of T20 Italy, the Italian Institute for International Political Studies, the think tank designated by the Italian government to lead the policy research process for this year. Within Observer Research Foundation, this dialogue is being hosted by the ORF Geoeconomics team, which focuses on multilateral economic relations, globalizations, and global financial system. We are delighted to have the Bombay Stock Exchange as our partner for this dialogue. Before we begin the panel discussion, it is my privilege to invite Mr. Rajaraman, Additional Secretary, International Economic Relations, Ministry of Finance, to first give a special address. He has served in various roles in government, including investment promotion, foreign direct investment, public sector, industrial infrastructure, and of course, taxation. Mr. Rajaraman, I invite you to give your special address on India and the G20. The floor is yours.
Good morning and good evening, good afternoon to all of you, I think. So it gives me great pleasure to be part of this group. I hope you can hear me.
Yes, we can.
Okay, thank you. So excellencies and distinguished participants, it gives me immense pleasure to join you today for this discussion. So let me begin by congratulating the Italian T20 team and the Observer Research Foundation for their excellent efforts in hosting this event. The T20's contribution to the G20 and serves to enrich the discussions by feeding its expert views and also forming an important conduit between the academia, research bodies, and government representatives. High-quality publications in various streams of T20, numbering as many as 11, would form very useful inputs to enrich G20 discussions. The chosen subject for today is very timely and relevant. We all agree that the COVID-19 pandemic presents an occasion to introspect on how resilient our global financial systems have been in the last 16 months and what reforms are required going forward. The G20 countries, collectively and individually, have undertaken numerous measures to support global economic recovery and enhance the resilience of the financial system. Noteworthy among these are the G20 Action Plan on COVID-19, the Extended Debt Service Suspension Initiative, the Common Framework for Debt Treatments Beyond the DSSI, a new special drawing rights framework for a general allocation of about USD 650 billion being worked upon by the IMF, along with voluntary channeling of SDRs on voluntary basis to the benefit of vulnerable countries. India is of the view that financing capacities of international financial institutions needs to be buttressed through legitimate means, such as quota increases, while also ensuring realignment of quota shares of members in line with their respective economic position in the world economy and allowing governance reforms. In this regard, we appreciate the commitment made by the G20 ministers and governors in their last meeting to revisit the adequacy of IMF quotas and to continue the process of IMF governance reform under the 16th General Review of Quotas, including a new quota formula as guide by December 15th, 2023. We also believe that the long-term financial resilience needs strengthening by way of promoting sustainable capital flows and developing local currency capital markets, which is something which is being actively discussed in G20. Developing countries have lost almost 5% of their GDP in 2020 as a result of the COVID-19 crisis. External financing needs for these countries are expected to have increased to up to 700 billion US as a result of the pandemic, with low-income countries needing around $450 billion over the period 2021 to 25. This is on top of the $2.5 trillion financing annually needed to support sustainable development goals and $100 billion annually for climate financing. So given the huge financing needs in low income in specific and developing countries in general in the coming years, the G20 efforts in exploring further possible actions to scale up development finance and enhancing synergies amongst partners is a step in the right direction. External financing has a key role to play in meeting this large magnitude of financing. It is necessary to have a detailed mapping of the demands as well as supply side of financing and tailoring response with country-specific plans. It is necessary to strengthen the capacity of multilateral development banks, which play a central role in doing development spending. The IMF has a key role in supporting countries with potential external risks and fiscal distress. Tangible progress is required in participation of private sector in these initiatives. Stronger private sector involvement is required to supplement the efforts of multilateral and other official creditors. Sustainable financing options will be needed for meeting these needs. Deploying instruments in new ways to mobilize private financing in those countries, something on which the World Bank Group is working, is required as well. We would also need to work towards optimization of the MDB's balance sheets, including effective and efficient use of their existing capital to maximize their impact. Over the last 16 months, extraordinary policy measures have been taken by both the fiscal authorities, that is the governments, as well as the central banks, in response to COVID-19 crisis, leading to a fairly robust recovery in many countries, and also a fairly good protection against financial stability risks caused by widespread corporate weaknesses, rising debt levels, etc. However, stronger and repeated waves of infections, the global economy continues to grapple with severe financial strains, particularly contingent upon the path of the pandemic. Ramping up vaccination, bridging gaps in the health infrastructure, and strengthening vital medical supplies can mitigate the pandemic's devastation and avoid lockdowns that could cripple economic activity. However, recurring spikes and prolonged recovery may produce strains in corporate balance sheets, which could migrate to broader financial systems, leading to domestic tightening of financial conditions. So India has been part of this global effort led by extraordinary fiscal and monetary measures by the Government of India and the Reserve Bank of India. They have supported resilience of the Indian economy in general and the financial markets in particular, with strong recovery prospects despite the glitch imposed by the second COVID spike. Fiscal policy measures include social security measures for food security, employment guarantees, enrollment of new workers in pension schemes, large investments in public health infrastructure, etc. The Reserve Bank of India's monetary and liquidity measures have also been aimed at restoring market confidence, alleviating liquidity stress, easing financial conditions, unfreezing credit markets, and augmenting the flow of financial resources for productive purposes. Regulatory forbearances have also been provided towards easing the situation while ensuring that the banking sector is ring-fenced from potential losses. India's digital payments infrastructure and inclusive digital payment systems with over 420 million bank accounts for the unbanked has helped in direct benefit transfers during the lockdowns as well. We see an enormous array of opportunities in the midst of this pandemic as well. Expanding digital financial services, including digital payments, e-commerce, telemedicine, online learning, etc., have exploded with the impact subsequent to COVID. These transformations need to be inclusive, ensuring access to SMEs, poorest and vulnerable. Enhancing the reach and reliability of social security systems for the poor and vulnerable is another laudable policy measure that various countries have undertaken. The rise of green and ESG finance is a positive sign for our collective global march to achieve the Paris goals. The broader global objective is to mitigate risks to the growth outlook while preserving financial stability. So going forward, our approach must be nuanced effectively to tackle short-term disruptions along with long-term adjustments. A one-size-fits-all solution will not take into account differences in country-specific circumstances and divergent impact of the pandemic on economies. Further, for a recovery which is sustainable, it is important that the system remains capable of supporting recovery without compromising on stability. I'm glad to note that the last G20 finance ministers and central bank governors meeting, the members discussed the costs of premature withdrawal of support, which have been put in place during the pandemic. And this could be more significant than maintaining that support for too long. The Financial Stability Board has provided timely guidance to the members that are on a flexible state contingent approach to minimize financial stability risks. So we must choose our priorities wisely and avoid disruptions which jeopardize recovery. Globally, the financial systems have remained resilient on the back of financial reforms which have disciplined the banking and financial sectors. So, however, the risks appear to have shifted on towards the non-banking financial intermediated financing. The G20 is working to bring resilience to NBFIs, particularly the money market funds. It will be crucial to ensure stronger governance in NBFIs, given their sheer size and interconnectedness with banks. Another area which the G20 is actively working is in implementing the G20 roadmap to make global cross-border payments faster, cheaper, transparent, and more inclusive. World Bank's recent statement indicates that officially recorded remittance flows to low and middle income countries reached 540 billion in 2020, just 1.6% below the 2019 total of 548 billion. The global average cost of sending $200 remains high at 6.5% in the fourth quarter of 2020, more than double the Sustainable Development Goal target of 3% by 2030. Supporting the remittance infrastructure and keeping remittances flowing includes the efforts to lower the cost of remittances. We hope that the Financial Stability Board and the CPMI roadmap to enhance the cross-border payments published in October 20 will encourage G20 countries, regulators, and financial market intermediaries to work towards the goal of reaching the target of remittance cost of 3% by 2030. Now, it is also very important to discuss ways to enhance the financial surveillance and further resilience against excessive capital flow volatilities and manage risks arising from such shocks. So we are also fully aware of the impact of climate change on financial stability risks and must work towards a green recovery. COVID-19 and consequences of lockdowns have underscored the fact that equity is key to any vision of sustainable development, including climate action. We believe that the solutions to any global challenge to be sustainable, they have to be equitable and take into account the varying priorities of nations. Further, at the time when recovery is a mainstay of all policy interventions, initiatives which inadvertently increase the risk perceptions of developing countries should be viewed with caution. So international policy coordination and appropriate communication remain critical for markets to prepare for any eventualities. India remains committed to contribute its fair bit as part of the international cooperation required in these extraordinary times. I will stop here and pass the floor to the panelists. Thank you.
Thank you so much, Mr. Rajaraman, for your address. We have a very wide audience that has tuned in to this particular panel discussion from all over the world. And our request to you was to provide a perspective of India's perspective on the G20, which you have done for us. So we appreciate it very much. You're welcome to stay on to the panel discussion with the other speakers. I leave that to you. It's completely your choice. I move on now to the panel discussion. The title of the panel today is International Finance, Still Fit for a Post-Pandemic World. We have a good lineup of speakers: Ashish Chauhan, MD and CEO of Bombay Stock Exchange, Asia's oldest exchange and amongst the world's largest; Tom Cardamom, CEO of Global Financial Integrity based in Washington, D.C., one of the leading and finest institutions dealing with illicit financial flows, illegal trade, money laundering, and risks in the global capital flows. Shilpa Kumar, who's also very well known in India as partner of Omidyar Network, where her work focuses on equity investments in early stage enterprises, providing grants to non-profits, the areas of digital identity, education, and financial inclusion. But of course, she was also MD. She was a banker. She was MD of ICICI Securities before she joined Omidyar. Alicia Garcia Herrero, the chief economist at the French multinational investment firm, and also a senior fellow with Bruegel. And of course, Franco, our counterpart from T20 Italy, who's also the vice president of Italian Institute of International Political Studies. I welcome you all, and I will pose the question, which is the first question to all of you, is going to be the same as the title of the panel. Is the international financial system still fit for a post-pandemic world? So this question, I'll start with Ashish, Mr. Ashish Kumar Chauhanji, and then we'll move on to the rest of the panelists.
Thank you, Akshay. Thank you, Mr. Rajaraman. It's a pleasure and honor to be in front of you. In a way, the way we look at it, I think broadly, I would agree with all points Mr. Rajaraman touched upon from the inherent disequilibrium that has come about due to the COVID pandemic and how the world has kind of gotten together to ensure that we overcome the COVID pandemic together in a more organized way. And I think overall, from Indian perspective, when I look at, I generally represent the private sector, the fundraising, the trade, and so on and so forth. And for me, I look at it in a way that irrespective of whether it is fit or unfit, the global financial system, I still have to work within that. And I will try to make best use of it for my population and my country, in addition to, of course, being a very responsible citizen of the world as a country. And that's what I would kind of look at it from that perspective. And if we kind of look at the numbers, in a way, we are recipients of almost $95 to $100 billion a year of remittances from across the world. We are also the beneficiaries of almost $85-90 billion of foreign direct investment a year, and also around $50 to $60 billion of foreign portfolio investment. So effectively, India is attracting close to $250 billion of capital from its own citizens working abroad or its own diaspora working abroad. But and that's adding into the financial stability that India has actually been able to bring to its kitty. Last few years, India's foreign exchange reserves have now kind of crossed almost $600 billion, which is a heartening thing. And that's giving tremendous amount of stability for Indian government to take on projects and activities which are basically ensuring that the entire society runs efficiently and without any hiccups. In fact, during the pandemic itself, almost first from April to December 2020, and now June 1 to almost October or November 2021, literally 15 or 16 months, India is going to provide food, free ration of food grains and other things to 800 million people. Already it has provided for almost 9-10 months and probably 6 months more. 800 million people is basically population larger than US and Europe combined. And also you can add Canada and still you will have some more remaining. And also Indian government has provided some funds in everyone's accounts, basically on the mobile based accounts where there is no leakage of funds being provided to below poverty line people. And that's where I think overall India is what I call a responsible member of the World Forum. And it's pretty used to now working with the world in a more equal fashion, that it is able to engage with the world and it's able to use all those and sort of all those channels which are available for transaction processing, for investments, for many other things to its own advantage, and also providing the benefits of its growth in terms of the capital appreciation for portfolio investors or direct investors, or even people who are lending money to India. Of course, India also has some backup reserves in case India needs to raise funds from abroad, which I don't see why it should, given its large reserves. But it also has a large diaspora across the world, which is able to find funding.
Yes, I can hear you.
Franco, the first question to you about the title of the panel.
Yeah. Okay. The economic policies have been reacting to the pandemic practically all over the world in a sufficiently rapid way, all in all in the right direction, I think, and with the favor of international institutions and of the G20. But both monetary and fiscal policies have been pushed in a strongly expansionary direction. Bank prudential regulations have been temporarily relaxed. International financial institutions and the global financial safety net, in spite of their limited size and insufficiently articulated facilities, have been helpful for supporting debtor countries. These reactions have been macroeconomically very helpful. However, This help has been reaching also agents that could do without it, while other agents and countries haven't obtained enough. Policies have been caring more about the quantity than about the quality of their interventions. Moreover, the international financial system is now charged with much more debt and is more fragile. The timing and techniques to normalize policies are difficult to devise and implement. Making mistakes could have dramatic consequences, in particular on financial stability. In the coming months and years, global cooperation must help policymakers to aim, according to me, in two directions among the many ones, obviously. First, improving the quality of macroeconomic support, also with a view on structural changes in the way we produce things, and as well as on the distribution of income, wealth, and power among agents and countries. Support must become increasingly selective, with much more care for the poorest countries and with incentives to correct public and private structural weaknesses that were present well before the pandemic. The current fiscal and regulatory incentives that favor all over the place debt over equity should be eliminated. When possible, public deficits should be substituted by fiscal transfers from the more to the less privileged. The second direction of cooperation should aim at gradually exiting the macroeconomic stimuli and the tolerance for increasing debt and financial risks. Exit policies are particularly difficult and delicate. They need a neat increase in the quality and quantity of global macroeconomic coordination, which must also be transparent in such a way as to earn credibility by financial markets. I'm thinking in particular, but similar issues can be raised looking also at other policies, to the unwinding of the monetary expansion that should be planned with different speeds in different monetary zones, but with a well-designed global coordination. And in fact, without transparent coordination between monetary authorities, current expectations of inflation and interest rates policies could seriously endanger financial stability, with the worst consequences burdening the weakest countries and inside each country the weakest agents. The G20 should be active in promoting this coordination. And let me conclude, if I may, with a 1 minute specific note on the European Union's macro policies. The European Union has taken advantage of the COVID crisis to take very important measures of common fiscal policies. Abundant funds have been directed towards the member countries that needed more support, with a carefully designed strategy favoring policies to support the unemployed, to finance health expenditure, to capitalize small firms, to direct investments and structural reforms with a view to the needs of greening our economies, helping the digital transformation, spending on education and research. To finance these common expenditures, new common taxes are devised, and new common debt will be issued on global financial markets. Many conditions are required now to make sure that this Hamiltonian moment, as some have named it, can be considered a sustainable development. In particular, I think we need that the European Union should have a unified representation in most international institutions, that the rules that govern common fiscal initiatives should eliminate the veto power of individual member countries, and that European Banking and Capital Markets Union should make quick progress also to enable the euro and European financial markets to play a much more relevant global role, thus providing, hopefully, financial stability and financial services for the benefit of the entire world. Thank you. This is my first answer.
I was going to ask, sorry, Ashish, you had a technical issue, so we moved the panel ahead, but I'll come back to you. My question was going to be to Shilpa, but looking at what Franco said, if I may be allowed to switch. Alicia, I'm posing the opening question to everybody. Is the international financial system still fit for a post-pandemic world? I saw you nodding to Franco, but you have one feet in Asia and the other in Europe. So which side do you come out on?
I'm going to talk about the world, and I know because Franco was my professor, I have to acknowledge this every time I see him in a panel. I realize how much I learned from him. In fact, I was about to say lots of the things he already mentioned, so I'm going to switch a little bit, and I'm going to compare, to answer your question, I'm going to compare what has happened so far to what happened as a result of the global financial crisis. And then I'll give you 2 good news and 3 bad news, if you allow me. So on the positive, I think everybody, especially the Fed, but I think everybody reacted so much quicker than in 2008. And as a result of that, we kind of had very different outcomes straight away. Yeah, we had a huge swing in capital inflows into the emerging world, which was welcome, as you can imagine, in March, late March, April, which we weren't expecting, because this crisis, as a matter of fact, if you look at the GDP impact, is bigger than the global financial crisis. Of course, I should start by saying that was a financial crisis. This wasn't, yeah, and that makes a difference in terms of the reaction. This was, in a way, the reaction was such that nobody's guilty, I am going to help you. The other one is, you're guilty, I'm not going to help you straight away, and I will only do so when I see that the whole thing is collapsing. So very different. But on that note, what started on a very positive note, liquidity for everybody, and as the crisis was becoming more global, rightly so. Yeah, we had a repo line from the Fed for basically every central or most central banks in the world, etc. And the capital came back. And that's kind of the good news. And what came as a consequence, in a way, because it made it easier, was fiscal stimuli everywhere, even in the emerging world. As a matter of fact, we had countries, including India, but Indonesia, others, doing things that we never thought would be possible, such as some kind of QE. So all of that, thanks to the realization, which was a great news, that this was not, nobody was guilty, and that's everything positive came thereafter. But as everything positive, lots of other things or unintended consequences come thereafter, and that's what I want to focus on. So the first one, I think, is that basically, as a result of this deluge, all of this money around, we basically had huge asset price inflation, and that's not good news for a world that is becoming more basically, more divided into the rich and the poor, as a consequence of who was basically ready to work, operate, invest in the digital world, and who wasn't. And we've all learned that this crisis was indeed very asymmetric in terms of its impact, and the asset price bubbles around the world have only made things worse. So that's the first unintended consequence. I hope it was not intended. That's why I say unintended. But the other one is that because all of these countries, and remember that the pandemic, in a way, it starts in China, then in a way the developed world, and then finally we have the whole emerging world there. In the interim, the emerging world managed to engage in huge, amazing amounts of new debt, which we thought wouldn't have been possible at the very beginning. Yeah. And that, in a way, has only made things worse in as far as we will have to deal with this debt at some point in time. And frankly speaking, now we have had a few sessions on the T20 on this. Even if the G20 tried hard to deal with this, frankly, it's just a drop in the ocean compared to what we need to see in the coming years, months. Who knows when the party will start, meaning capital outflows and what comes next. So that's the second unintended consequence, that in a way there was too much of a good thing, and debt continued unabated, and perhaps not where it should have continued. Now, is this a problem for everybody? Because debt continued unabated in the US. But to me, at some point in time, and this is the third thing I wanted to say, that as we see a divergence in growth, i.e. the developed world is kind of halfway vaccinated, if not more, there will be a time, and we already see it on the inflation front, that they will need to exit. But maybe before others are ready for them to exit. You see, like the emerging world won't be ready for the Fed to exit. And I think that's another unintended consequence, because what started as a pandemic and a global shock might end up being a partial or, a shock somewhere, but not elsewhere. And that elsewhere happens to hold the most important central bank in the world. So that's another unintended consequence that might end up having this crisis look much more than previous ones, even if that was not the beginning of it. And that worries me enormously. So basically, in a nutshell, asset price bubbles, consequences on middle income to poor, the poor part of the population. And then, of course, debt dynamics, debt restructuring, what to do about it, especially in the emerging world, because, of course, not holding a reserve currency. When the Fed exits, which is the third point in time, not only are you not in sync, but you need to deal with debt that will be more costly. So the two and the third consequences come together in a way. And I think that's really a sandwich you do not want to be in. And that's where I end. So we've seen, in a way, the best of it, but I'm worried about these unintended consequences that we'll still need to deal with. Thank you.
Shilpa, thanks for your patience. Over to you now. Do you share these concerns, or are we really concerned about other things when we look at the international financial system from India?
Yeah, thanks, Akshay. And I think I like the fact you put me after Alicia, because what I want to say actually fits right into what she said. And let me start by saying, for me, the pandemic felt like it was the first time most people in living history would have seen something that affected the whole of the world together. And it kind of highlighted, our interconnected world, but also highlighted our very unequal world. And the fact that unless the whole world is healthy, really you're not going to be able to see progress of the globe. And therefore, to my mind, what we need to head towards is a stronger and more agile global financial system. And let me, start off by saying that the divergence we talk about, I think, to my mind, it's at three levels. The first divergence is really the global south and the rest of the world. The second is within each country, even within countries like India, there's a divide between, I would say, large corporates and smaller MSMEs and micro entrepreneurs. And the third divergence is even within, every country, there's a divergence between the more well-to-do population and those on the other side. And I think we are now a world of divergences, which needs to converge if we are going to move forward. When I look back, what strikes me is that some things worked. In spite of all these divergences, something worked post-pandemic. The first thing was really technology. When I look at the fact that technology and digital rails that even countries like India have put in actually were able to respond to people at short notice. And let me use India as an illustration. The fact that, because we had digital identity, Aadhaar, linked to bank accounts and mobile numbers, when the pandemic struck, actually, in the first 4 months itself, we could reach 40% of the people who needed relief with some form of help. And this number went up to 80%, with the passage of another few months. So I think really technology has a big role to play. That's the first thing. The second thing is, I thought coordinated central bank action and fiscal action also helped because it really ensured that we didn't see, a sudden collapse. But having said that, I want to now go back to the divergences I spoke about and say that, while the coordinated action did help, it actually also accentuated differences. And First difference at a country level, I think global South could spend much little in terms of fiscal room to aid recovery. And that really accentuates the difference between countries. The developed world could spend 5 to 6 times more. The second point is, because within corporates, you had micro entrepreneurs, MSMEs, who lacked formal structure. Therefore, a lot of the central bank action that happened could not reach them. So, in India, the central bank said moratorium, which was great, but it did not reach people who were dependent on informal credit and therefore were not covered by these formal structures. The last of the divergence was, at an individual level. In a sense, we've talked about that earlier. So maybe at this point, I will simply say that fragile individual balance sheets also did not benefit fully from all of these actions. Again, because of the fact that these last mile providers of credit could not access some of the central bank action. So while liquidity was flush, it did not get accessed by last mile, say, credit providers for whom actually borrowing costs went up dramatically, and for whom also lending contracted dramatically. So I just want to leave the thought that if we are to be a stronger, more resilient, more agile world, probably, it's time to look at more specific actions which target the people on the other side. Thank you, Akshay. Back to you.
Thank you, Shilpa. And Tom, also thank you for waiting patiently. The question to you about international finance still fit. I think you've always found all the appropriate, you found lots of loopholes for us to consider on the current financial system. Love to hear what you have to say about the post-pandemic financial system.
Well, thanks, Akshay. Yes, there's a couple of points I want to make. One has to do with the movement of money around the world, and the second point, which I think is related, is the movement of goods around the world. I think both are going to be key in post-pandemic world. Both are key to increasing the resilience of especially developing country economies. On the first point, as far as the movement of money, I mean, we know that money laundering and tax evasion and grand corruption, all of which are facilitated by the global financial system, have increased into the trillions of dollars a year. And with every new bank scandal, the legitimacy of the global financial system is called into question. So what's the solution? Transparency and accountability and integrity of that system is absolutely key. And what do we mean by that? Well, beneficial ownership of companies is certainly a growing global norm. It needs to be expanded beyond what it is now. That beneficial ownership information should be publicly available, shared widely. Information silos are the death of trying to create any type of transparency or accountability. The more data that's shared, the better. Regulation of gatekeepers, certainly a component of this. Auditors, attorneys, real estate agents, other professions dealing with large movements of wealth around the world. There should be a harmonization of the regulations for those industries. In many countries, they are not regulated or regulated weakly. Increased or more strict punishment for financial institutions that paint outside the lines, shall we say, and that facilitate the movement of illicit money. These aren't difficult problems. They're not technically difficult. It's a matter of political will. We've seen some countries do very well in these areas, others not so well. And hopefully the G20 can begin the process to sort of raise those raise those boats in the countries that are not up to stuff. Now, I will quickly add the statement earlier that there has to be some nuance to this, given individual countries' requirements is well noted. De-risking of banks is certainly one where we see remittances cut off to specific countries. That doesn't help people in those countries. That does not add any significant amount of risk deflection by financial institutions. So there has to be some understanding of how these things get implemented. But let me also turn to the issue of global trade. You listen to any global financial institution, whether it's the IMF or the World Bank or the UN, there's a common refrain as regards to trade, which is international trade is the lifeblood of the global economy. And yes, it absolutely is. And increasing global trade will help developing countries grow their economies. Vitally, vitally important. But our data also shows that the illicit trade in legitimate goods like timber and fish and minerals, as well as counterfeiting of a whole host of consumer products, is easily $1 trillion a year. In addition, there are transparency problems in the global shipping field as well. Our data also showed that at least a quarter of global container ships are run by opaque entities. Companies that operate the ships are opaque. The free trade zones that these ships visit on their way to their final destination are opaque, making it extremely difficult for law enforcement to crack down on illicit activity in the shipping industry. And of course, data also show that the mispricing of goods is rampant. There's no country that does not have a problem with this. Many, many, many billions of dollars in customs duties and VAT taxes are lost to developing countries each year. So what needs to be done? Well, Global Financial Integrity believes that new global trade integrity standards should be implemented, and this certainly we believe should be a discussion point for the G20 countries. What do we mean by trade integrity? Well, what we're talking about is instituting rules, regulations, and technology too. This is where technology can play a role to help to ensure that the global trading system is legitimate, transparent, and where the goods are properly priced. Speaking of technology, we have a tool, a cloud-based database that we provide to country customs departments and central banks and financial intelligence units so they can keep an eye on their trade transactions, so they can identify when goods are not priced properly. And so investigations can take place. So there are things that can be done to ensure the trade integrity of the global system. What needs to be done? Well, again, G20, UNCTAD, WTO, WCO, Interpol, there are a whole host of multilateral institutions that can play a role in instituting these new rules and regulations and perhaps technologies that can address these problems of a lack of transparency and the movement of illicit money around the world. So with that, I'll back to you.
Actually, hearing Franco and Alicia and Shilpa and you, Tom, I think looks like Ashish was the only one who was more sanguine and positive. Shilpa talking about divergences of multiple kinds. I think you hinted not just economy, but also inequality. Alicia talking about long-term impact. Although you talked about the quick responses by the Federal Reserve, probably even the IMF and the G20, but long-term impact and with emerging markets taking on that much debt. Franco talking about quality. So I want to suss out Franco and Alicia and Shilpa. Maybe Shilpa, starting with you. how do we? So what do we do? We want to get a second round of answers in, probably this time a little bit more abridged, if you can, please. But how can we address this issue with the global financial system, where the liquidity that you're pumping in, as you're saying, is not reaching the intended participants? The digital interconnectedness that we have is actually causing probably divergences, may even cause a contagion later. We're just not seeing it now with the digital payments that are coming in. So, Shilpa, what can we fix in the international financial system?
Yeah. So I'd say three things. What incentives can the financial system put for more formalization? How do we get more industries, through the value chain to be more formal? I think that's first. A second is how do we ensure that digital rails for relief are there for most of the world's population? About 75% live in global south, and how do you ensure relief is available across in times of need? And the last one I'd say is more affordable credit, more credit and more affordable credit for those at the bottom of the pyramid. So that would be my kind of quick list. Happy to talk about it if we have the time.
Franco, how do we get quality? We are barely being able to manage, being able to get the quantity to the right stakeholders. Ensuring quality is even harder.
Yes, it's a very complex moment. It's very delicate. I mean, we can make mistakes every time. Let me just make 2 points. One, to reach the degree of cooperation we need in a situation where, in fact, it's not a peaceful world. I mean, there are contrasts everywhere, and in some of these contrasts are really dangerous for global security, war and peace, things like that. So we have to, at least global diplomacy has to obey one rule, which is keep separate tables. You cannot confuse certain tables where you can conflict a lot with other tables where you are obliged to cooperate. And you should not have anything against these different approaches to the different tables. So this, I think, it's a very important rule for international diplomacy. I hope that the G20 this year proves that we are able to, converge on certain issues while we know we diverge a lot on other issues. Another point is health policies. In terms of quality of where the money goes, we need a lot of attention to investment and care for health policies all over the world. And here also we need cooperation and central coordination. There's been a proposal made to the G20 this year, and it's now under consideration. And this is to create inside, I mean, aside from the G20, to create something like the Financial Stability Board after the crisis of 2008. And this, instead of looking directly at the finance in general and financial regulation, this group, this entity that could in some way overlap with the World Health Organization should care about health policies in a coordinated fashion, but linking them with finance, because you need a lot of money to take care of health. So we need to look at the situation of the world and cooperate to direct capital towards prevention of new problems, but also improvement in general of the health of our populations. So these two points, I think, are under the attention of the G20.
Okay, Alicia, certainly we've made more progress, right? You were so concerned about the long-term impact, asset price, because of all the easing. I mean, a lot of it is history repeating itself in some of the points you made, but we must have made some progress. Are we still, are the sovereigns still as risky as they used to be? Argentina has restructured a few times. We've not felt it. Are we that brittle? Is the international financial system still brittle? Is it not more resilient than it used to be? What else is left to fix?
Yeah, I think the financial system became much more resilient after the global financial crisis, as a matter of fact, because in a way we forced them to be. Yeah, I mean, especially banks have been subject to humongous pressure, regulatorily speaking, capital requirements, you name it, macro proof, everything on earth. So of course we're more resilient. At the very same time, though, there's new aspects of the international financial architecture, which we know much less about. Yeah, there's huge shadow banking in China we know little about. There's much more household debt in poorer countries, China included. Yeah, and we don't know how to deal with that household debt very well, to be frank. There's also the crypto world, digital assets, let alone new central bank digital currencies coming over, huge digital payment systems, lots of things we don't know about. So while agreeing that, yes, we've learned, and maybe the old things we were worried about, say contagion from Argentina to Brazil, all of that probably is old, because financial markets have learned to disentangle differences. The new risks we do not know about. So I don't know whether, how to weigh the two, whether to remain positive or less positive, but certainly the type of risks are different. That's
Okay.
Let
me come to you, Ashish ji. We do have close to $12 trillion in reserves around the world. Shilpa spoke about maybe affordable credit. Alicia is still concerned about emerging markets taking on more debt. From your perspective, is that a risk that investors are pricing in? I mean, is that something that investors, as well as, both short-term and long-term investors, or even the government, do they have this understanding, and is there accommodation for this kind of risks that are coming up? What do we need? How do we fix it this time?
I think we give investors very little credit for their smartness. We are the Chetrati class. We talk a lot, but we don't put our money where the mouth is. They do. And so they are much ahead of us in some ways, And one of the reasons why they continue to pour money is because across the world, governments keep on pouring the money. By quirk of fate, we are discussing it in 2021. We are celebrating, not officially, but by flushing the world with a lot of new money. We are actually celebrating Richard Nixon's announcement, taking away the dollar from gold backing on 15th August 1971. And so for me, world is in a continual expansionary model with World Bank and IMF at the helm, and the central banks working with each other together to ensure that the world keeps on getting more money in each crisis. And that is actually increasing the asset prices. That's why investors are flooding the asset markets. Of course, the inflation in the consumer goods like agri prices and other things are not happening because of increase in the arable land and also increase in productivity. And that's why you don't see that kind of inflation till now. You don't know whether it will hit you sometime in near future or not. But for me, this what I call peace is short-lived in a way. At least we should take it into the risk management framework in case the tsunami of money which we have unleashed over the last 50 years suddenly starts overwhelming us and starts running ahead of us. But investors are aware that today it's in nobody's control. Every government wants to be keeping everyone happy, and the only way to keep everyone happy is by putting more money in the world. And that's where basically the way to reach out to people who need credit and all is basically through automation. I think Shilpa alluded to that. Indian model for me is a very interesting model from tax collection perspective. As Tom would have sort of put it, we have a GST model which no other country has in the world pretty much. GST model of India is pretty much, I think, the best in class. Similarly, the direct tax collection model of India is also now pretty much sort of best in class in using technology to reduce minimal interference by the officers and so on and so forth, and reduces corruption manifold. E-governance on every aspect of including giving away the credit or even the subsidies to every individual without any leakages. Again, India has mastered that. Fintech, where I can send you 1 cent from any bank account in India to any other bank account in India. We are doing almost 2 billion transactions a month now, every month after month. And that is, I think, you can emulate in the rest of the world. Many things India has done over the last 10 years are not visible to the world because that are what I call soft infrastructure. The hard infrastructure, the bridges and airports and ports, which is what is called developed world, is what I call the infrastructure of the past. The infrastructure of the future is what needs to be built, and including the beneficial ownership, as Tom pointed out. India has a beautiful system of figuring out the last person holding the stake in that company, which US has with its omnibus accounts and everyone else having their omnibus accounts do not have. So for me, somewhere on the line, India is kind of thought leader, execution leader, and somewhere if we implement what India has done in a even partial basis, the world would be a better place in terms of risk management, in terms of reaching out to people, in terms of creating what I call more robust financial system, which is also equitable and also is able to collect taxes where it is required.
Thank you, Ashish ji. I think we'll give Tom the last word. Tom, maybe you only have a minute. That's not too long, is it? Just to tell us what your hopes are from the G20, and are you optimistic with the role that the institution has played and what it is supposed to do to see us through these times?
Well, I think we all have to be optimistic. If we're not optimistic, we can be critical about the way things are, but I think we need to be optimistic to help these institutions think about these very important issues in new and more effective ways. So I'm confident that the G20 can begin to address some of these issues. The last point I'd like to make is sort of connected to your comment that there's $12 trillion in reserves around the world. There's also been studies done that suggest there could be as much as $30 trillion parked in tax havens and secrecy jurisdictions. There is a tremendous opportunity cost to having that money being essentially unproductive there. We've talked about cheaper credit. There could be more FDI if that money was released. ODA has been flat. So there's tremendous need, of course, and perhaps the G20 can begin to think through how some of that $30 trillion in money parked in those jurisdictions might be leveraged to help the resiliency of the developing world in the post-pandemic crisis.
Okay, I've been told by my colleagues that actually there are many questions that have been posed to you, but and including there was one on tax havens which you've answered, I think, or at least you've already responded to. But there is one that has come up that we can see on our screen related to digital taxation. This was an announcement that was recently made by the G7, actually just yesterday, that they're coming to some kind of understanding on taxation of digital multinationals or how digital services are actually rendered. So maybe Shilpa, can I ask you to respond to that, because you've spoken about digital interconnectedness, and how do you view this effort that the G20 and multilateral bodies are now taking on to find a standard way of taxing and regulating digital multinationals and digital transactions?
Yeah, actually, so maybe I can go back to my point about equity and divergences, and I would say this is another illustration of inequity, because you have large markets with very vibrant consumers and businesses, but not in a sense giving back to the economy where these businesses thrive. And so maybe it's part of the overall debate on equity, towards which we certainly need to move.
Okay. And there is one last question, and then we will finish. Can the financial institutions launch a Marshall Plan to tide the pandemic and the financial crisis? So that question I'm going to give to you, Frank. What do we have? What G20 is doing, is that a Marshall Plan? $650 billion in SDR, I don't know, about $12 trillion or so in monetary easing around the world. Is that not like a Marshall Plan already, or do we need a Marshall Plan still?
Well, Marshall Plan is more about the amount of financing, and we need a global coordination on health policies, and vaccination issues is crucial. We have to realize that health is a global public good, and as financial stability was we realized that this was a public good after the 2008 crisis, and we created the Financial Stability Board. And it was successful because in a couple of years, some things changed. I mean, not sufficiently, but some things changed. I think we should do the same with health now, and have a sort of a global authority taking major decisions on, and then should be adopted by countries, and implemented, but with a lot of cooperation. And we're all recognizes since the beginning that having a health policy is costly. So there must be finance ministers together with health responsible. Finance ministers must be deeply involved in public health. This is something that we should also take care in Europe, by the way, where our centralization of health policies is insufficient. But it's a more global issue, and to some extent, certain health issues should be brought at the global level. And I must say that the WHO is not up to the task. It doesn't seem to be at the moment up to the task. So we need.
Okay. We will leave it there because WHO is not the subject of the discussion today, but that does definitely lend itself to another discussion, Franco. With that, we're out of time, and all that's left for me to do is thank all the panelists. I will not make an attempt to summarize, but thanks to all the panelists, Ashish, Shilpa, Alicia, Tom, and Franco for being with us today. And for the audience, please follow us on ORF Online for more research and analysis and discussions on the G20 and other aspects of geoeconomics, such as globalization, global supply chains, and international financial architecture. With that, good night, everyone from India.